All right, we're back on the record in case number 26-90447 QVC Group, Inc. Mr. Glenn, you may
Thank you,
proceed.
Your Honor. Thank you. So, Your Honor, I have a binder for the witness of some exhibits, and I have one for you if you'd like. You should keep that because we're going to refer it.
Okay, that's good.
Use your deposition transfer. We might refer that.
Okay, that's fine.
Good afternoon, Mr. Kearns.
Good afternoon.
Again, for the record, Andrew Glenn for the preferred shareholders. You ready to proceed?
I am.
Great. So am I correct that PricewaterhouseCoopers, PwC, assists the company in filing its tax returns?
Yes, they assist in the preparation of the returns. Correct.
And you consult with them from time to time about various tax matters, including the tax opinion that you testified to earlier today?
Yes, sir.
Thank you. And KPMG is the company's auditor, correct?
Correct.
And you interface with KPMG from time to time on tax reporting as it relates to the audit practices, right?
I do.
And you are the senior-most person at QVC, Inc. that works on tax matters?
I am.
And you are the senior-most person at QVC Group that works on tax matters?
I am, yes, sir.
Okay. So you testified earlier that the QVC family of companies follows a consolidated tax return, correct?
That's correct.
And you're familiar with the IRS consolidated return regulations in the ordinary course of your work, right?
Yes, sir.
Okay. And you testified about tax sharing agreements in effect at the company dating all the way back to 2004. Do you recall answering those questions?
Yes, sir.
Okay. Now, the tax payments that QVCI has made during your tenure have been pursuant to the 2004 tax sharing agreement, correct?
Well, it would be the 2004 with the assignment assumption agreement as well. Yes, sir.
Okay, but those are the only two tax sharing instruments that govern the payments from QVCI to QVCG, correct?
That's correct.
Okay. Now, you testified about an assignment of the tax sharing agreement. Do you recall those questions?
Yes, sir.
Okay. What is the relationship between Curate Retail Inc., QRI, and QVC Group, Inc.?
It's the same entity with a name change.
Okay. So
Curate Retail Inc. is the ultimate parent public company, and they did a name change to QVC Group Inc. So it's the same entity.
okay, so I didn't quite understand your testimony when you were asked. You can refer to the white binder again.
Okay.
DX Exhibit 1.
DX.
Exhibit 1 should be close to the front.
Okay.
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 So, actually, let's start with 2 to make this clear for the court. So, DX2 is the 2004 tax sharing agreement, correct?
That's correct.
Okay. And DX1 is the assignment and assumption agreement for that agreement, and assigning that agreement from a Liberty entity to this Curate Retail Inc. entity, correct?
Well, when you say that, you're going to have to rephrase the question, because the Liberty entity is in the QVC. Do you want me to explain?
You know what? Let me help you out here. Let's go back to DX2. So DX2 has Liberty Media Corporation as the counterparty to QVCI, correct?
Yes.
Okay. And the counterparty to QVCI under the assignment and assumption agreement, DX1 became Curate Retail Inc., correct?
Yes, and I can explain that.
Sure, go ahead.
Okay. Liberty Media was the public company that owned QVC Group. There was a transaction in which Liberty Media became a subsidiary of a new holding company above Liberty Media, and let's call that Topco or QVC Group. So you got QVC Group owning Liberty Media Corporation owning QVC down the chain. Liberty Media Corporation, as part of that transaction, became a single member LLC, and it was originally when they created the single member LLC, it was called LMC LLC, and they changed the name to Liberty Interactive LLC. So Liberty Interactive LLC is the old Liberty Media Corporation going underneath the new holding company, and the holding company is QVC Group Inc. Does that kind of make sense?
It's complicated, but I think we all...
Yeah, there's another Liberty Media out there, but it was a spin-off in a separate in a transaction with another name change. But that's not this public company. This public company that is referred to in this document, Liberty Media Corporation, is the existing LINTA that everyone's talking about. It's a wholly owned sub of QVC Group.
Bless John Malone's heart.
Yeah, it's tremendous.
Okay. So you were asked by Mr. Esser about tax payments that preceded the assignment and assumption agreement. Do you recall being asked questions
Yes.
about that? Okay. So prior to the assignment and assumption agreement, Mr. Esser implied that somehow you were gifting tax payments to QVC Group because it wasn't subject to, or Curate Retail, because it wasn't subject to the tax sharing agreement until the assignment and assumption agreement and DX1 was signed. Do you recall being asked those questions?
I don't recall being asked if there was a gift. I recall being asked where the payments were made, and I answered the question. Yeah.
The payments were made to whom?
Well, the payments were made to what is QVC Group Inc. or Topco today.
Okay, and that was Curate Retail Group.
Yes.
Why?
I don't know why, to tell you the truth. We get approval. My group gets the approval, and then it goes to Treasury, and I don't control that part of the transaction.
Did you ever double pay the taxes that were owed under your tax sharing agreement?
No.
Okay, so let's go to the DX2. Okay, so DX2 paragraph 2, I think you testified about this earlier, indicates that you QVC Inc., were to pay your separate return tax liability, and it says by QVC to Liberty. Do you see that title?
You're on page 4?
Page 4, paragraph 2, sir.
Yep. Yes, sir, I'm there.
Thank you. Okay, so is the sum and substance of this paragraph that QVC Inc. is supposed to calculate its tax liability independently of what the other tax positions of the other QVC entities would be?
That's correct, with the exception that I've talked about before, where we don't get credit for our foreign tax credits until the parent can use them.
Okay. And what this paragraph and paragraph 3 say in sum and substance is that you're to send that money to the lead taxpayer, correct?
I mean, yes. I mean, that's where it's supposed to. I'd have to read paragraph 3.
Well, I don't want to stop you.
Oh.
Let me ask you another question, which is, and I think you implied this by a prior answer. So you never double paid taxes under this agreement, did you?
No.
Okay. And so I believe your testimony just a moment ago was that the tax accounting representatives of the Liberty Media umbrella entity told you what to do, correct?
we computed the tax, sent it to them for review, and they said they would say approved, and then from there, I didn't control the payments. That goes to Treasury. But but that was the process.
Okay. But regardless, you didn't double pay what you were owed?
No, we didn't double pay.
Thank you for that clarification. We'll put that down for the moment. Now, would you agree with me that tax sharing agreements of this kind are relatively common among companies with various corporate entities?
I don't know. The tax sharing agreements are not uncommon. Ours has a twist to it that I've talked about a couple of different times with the foreign tax credits and other losses that we don't get credit for until the parent can use it. I would say that's kind of that can be viewed as a punitive element, but other than that, the tax sharing agreements are not uncommon.
Okay. Now, you've been at QVC since 2015, I believe?
Yes, sir.
Okay. During that time frame, has the existence of the tax sharing agreement been publicly disclosed?
Yes.
Okay. Has anybody from within or without the company challenged the tax sharing agreement?
Not to my knowledge.
Okay. Has anybody ever said it's illegal?
Not to my knowledge.
Has everybody tried to avoid that agreement?
Not to my knowledge.
Okay. Now, let's talk about how you go about calculating the separate return tax liability. Now, the tax sharing agreement that we just saw provides for payment of estimated taxes from time to time, correct?
Yes, sir.
And that would be customarily on a quarterly basis, right?
Yes, sir.
And there's a review process that you undertake each and every time that you calculate those taxes, correct?
That's correct.
And then at year end, there's a reconciliation process, and a year end number is paid for that tax year, right?
Yes, sir.
Okay. Now, isn't it the case, sir, that you, on behalf of QVC Inc., calculate what is owed under the tax sharing agreement by QVCI independently?
Yes, sir.
Okay. And then the next thing you do is you liaise with the parent company, formerly Liberty, now QVCG, to reconcile those numbers and come to some final determination about what is owed.
That's correct.
Okay. And then, I think you just testified about this, the monies would be transferred consistent with those calculations to Liberty Media or however they designate it, right?
Yeah, to Topco.
Okay, thank you. And the word Topco, I just want to be clear for the record. Topco refers now to QVCG, correct?
That's correct.
Okay, and then before QVCG existed or had a different name, it was Curate Retail Inc. was Topco.
That's correct.
Thank you. Now, isn't it the case, well, this wasn't the case of Liberty Media or QVC Group dictating to QVC Inc. what it would owe under this tax sharing agreement without independent review by QVC Inc. representatives, including yourself?
That's correct. We prepared it and they approved it.
And during the time frame you've undertaken this work, isn't it the case that you can't recall any significant discrepancies in the calculation of tax between QVC Inc. on the one hand and the Topco representatives that you worked with on the other hand?
I would agree with that.
And in fact, you are the ultimate authority on behalf of QVC Inc. for those calculations, are you not?
Yes, sir.
Okay. Now, you believe that all payments over the last several years made by QVC Inc. were made in accordance with the tax sharing agreement, right?
I agree with that.
They complied in all material respects, right?
Yes, sir.
Okay. Now, and you were involved in all those calculations from at least 2020 through 2025, right?
I would say 2016 through 25.
Even longer. Thank you. And then you would submit your work papers to KPMG for their review in the audit process for the company's SEC filings, correct?
Yes, sir.
Okay. And isn't it the case that KPMG ultimately agreed with your calculations based on their inclusion in the audited financial statements?
They would agree with the tax provision and what went in, and they have full access to everything we did.
Okay. Now, QVC Group has been involved with IRS income tax audits from time to time, right?
Yes.
Okay. And isn't it the case that you've been subject to something called the CAP program?
Yes, sir.
Can you explain to the court what the CAP program is, please?
Yes, it's a continuous audit program in which the IRS audits us year-round. At the end of each quarter, we submit an agreed-upon set of work papers, agreed-upon set of disclosures of transactions. We meet with them monthly, so it's a real-time audit for the year as the year is progressing, with an agreement to deliver a tax return, and they review each quarter, and you agree to answer their queries expeditiously and to file a return in enough time for them to review it before it gets filed.
And how long has that been in effect?
Oh boy, QVC, ever since I've been there, and that particular, and Liberty was one of the first CAP companies in the program.
Okay. And is the CAP program ongoing now?
Yes, sir.
Okay.
For 2025 and 2026.
Okay. And
No, pardon me. 2024 and 2025.
I thought so. Okay. So in that time frame that the CAP program has been undertaken, have there been any material adjustments as a result of those audits under the CAP program?
Well, we get adjustments that we agree to during the year, and we make them in the return before we file it. That's one of the beauties of the CAP program. And then we file, and we're allowed to give the IRS, and they audit the return more in depth once we file, and we're allowed to give them post-filing adjustments, which there's always what we call a post-filing, which is us giving them stuff that we found after we filed. And then there's always adjustments, but I can't recall what would be a real material change. But there's an IRS report almost every single year with both the post-filing adjustments go in that IRS report, and then anything they find goes in there as well. And there's almost one every single year.
Okay. So I'd like to talk to you now about the intercompany tax payments under the TSA and how the company records them. From time to time, isn't it the case that QVCI might be in a overpayment or an underpayment position relative to what it owes QVCG?
Well, if we're in underpayment, they want their money. I'll tell you that. So it doesn't last for long. They want their money. If we're in overpayment, they'll credit it to the next estimated tax payment.
And is that how the TSA works? The credit is supposed to be given?
Yeah, yeah.
Okay. And so I'd like to talk to you about how these overpayments might be recorded on the company's books of records. Isn't it the case that those are recorded from time to time as an intercompany account payable?
They are.
Okay. If QVC Inc., which you say is unusual that it would actually be owed money, that would be recorded as an intercompany account receivable for QVC Inc., right?
That's right.
Okay. Now, those intercompany accounts payable and receivable are in fact recorded on the company's SEC financial statements, right?
That's correct.
Okay. And the financial reporting, the SEC reporting, was handled by Liberty Media up until 2025, right?
Through June of 2025, Q2.
And then after that, QVC Group, QVC Inc. took over that responsibility, correct?
That's correct.
Now, as part of your duties and responsibilities, you review the footnotes in the company's 10Ks and 10Qs concerning tax matters, correct?
I do.
Okay. And when I say the companies, I mean you review both QVC Inc.'s financial statements, those SEC reports, correct?
Correct.
And you review the ones filed by QVC Group, correct?
That's correct.
And the difference between that financial reporting, broadly speaking, is that QVC Group consolidates all the subsidiaries into that financial reporting, right?
That's correct.
Whereas the financial reports for QVC Inc. are consolidated only between it and its subsidiaries, correct?
That's correct.
Okay, so if we wanted to see transactions between QVC Inc. on a tax basis and QVC Group, they would be reported only on QVC Inc.'s SEC financial reports, right?
That would be, well, the two dovetail. I mean, so can you re-ask the question, please?
It's okay. It's
okay.
not important. Let's
Okay.
move on. Now, for the footnotes and the tax reporting in the financial statements filed with the SEC, your customary practice is to review the work done by your staff, and then you review that before it's actually submitted to the people who finalize those documents, right?
That's correct.
Okay. And you attend meetings with KPMG from time to time concerning those SEC reports, right?
That's correct.
Okay. And to your knowledge, there have been no material misstatements in QVC Inc.'s financial statements concerning any of its tax reporting, correct?
That's absolutely correct.
Okay. You haven't committed any fraud?
No, absolutely not.
Thank you. And so since 2020, you would agree with me that the descriptions, the footnotes, the narratives about the tax have not contained any material misstatements or fraudulent statements while you've been working on them, right?
I would agree with that for sure.
Okay. Now, the number reported in the QVC Inc. SEC financial statements for the income tax expense is determined in accordance with what is owed under the tax sharing agreement. Is that right?
It is calculated in accordance with it, but it is not what is owed under the tax sharing agreement.
Okay. Can you explain that to me, please?
I can. I'll go slow because this is complicated.
Okay.
If we have a foreign tax credit that our parent, QRI, can't use, let's say we have a foreign tax credit for $100,000 actual credit that we can use on our separate return, what the GAAP rules say is we reduce our income tax expense in the year that we can use it, even though the parent can't use it. So if our taxes were $200,000 and we had a foreign tax credit of $100,000, our tax expense would show the lower number for GAAP. That's not what's owed on the TSA. The TSA, I may have to pay them that $100,000. So there's a correlation in determining the taxable income, but after that, the foreign tax credit mechanism with the TSA plays a factor in the tax expense that's recorded on our financials versus what gets paid under the TSA.
I believe Mr. Esser had asked you some questions about this discrepancy in your direct examination. Do you recall that?
I think he did.
And these foreign tax credit reconciliations, they don't involve huge numbers, right? We're talking in the single-digit $1 million.
No, these can be big numbers. They can be very, very, very big numbers. If you look in the 10K capital section for 2021, you're going to see a $73 million tax benefit if we have that. In the 2021 10K, there's a tax benefit that we got for the TSA that we previously got in our financials. So what ends up happening there is we did not have to pay the parent $73 million. And it's in the capital section of the 2021 10K. And that's a pretty material number.
Okay.
So what happens in the past, in the prior years up to 2021, the way the foreign tax credit works with QRI is financial statement benefit is taken, so our taxes are less in our financial statements. But we had to pay that money to the parent, and in each 10K in the capital section, you'll see an entry that says dividend, and I forget the exact wording, but it's a separate line item. It would say dividend attributable to tax sharing agreement, and that's the money over the course of time that we paid them, that we didn't get benefit. And then in 21, they used 73 million of that accumulated tax credit, and we did not have to pay them 73 million in tax, but that benefit was taken on the tax expense line in the 10K in the previous years. So the tax expense on a cumulative basis in the 10K, depending upon the period of time you're looking, is not going to equal the TSA payment. There's a difference there.
Fair enough. But ultimately, whatever is reconciled and paid is in accordance with the tax sharing agreement.
Absolutely.
Okay. So I'd like you to go to your binder, please, and I'm going to call up JX14, please.
In my binder.
In the black binder, I'm sorry.
Exhibit 6 in the black binder.
Five.
I'm sorry. Well,
How did you know that? Okay.
I'm sorry, it's tab 5, JX14.
Okay, this is, okay, I'm
We
there.
have many numbers here, sorry.
Yes, I'm there.
Okay.
It's Exhibit 6, JX0014, right?
Yes.
Okay, cool.
And for the record, this is a QVC Inc. 10K, correct?
Yes.
And this is for the year ended December 31 of 2025.
That's correct.
Okay, thank you. If you could please turn to the page marked Romanet 2-50. It's about 7/8 of the way through the document.
50?
Yes.
Is it number two, Romanet 2?
Romanet 2-50.
Okay.
And for the record, we're looking at a page with the title QVC Inc. Notes to Consolidated Financial Statements Continued.
Yes.
And we're going to focus on the narrative above, and we're going to focus on the chart immediately below that.
Okay.
So we have here, at the top of that table, it's entitled A Reconciliation of the 2024 and 2025 Beginning and Ending Amount of the Liability for Unrecognized Tax Benefits is as follows.
Mm-hmm.
Okay, and then below that, it says income taxes paid during 2025 by taxing jurisdictions are as follows. Do you see those?
Yes, sir.
Okay, again, this is for QVC Inc., right?
Yes, sir.
Okay, so the narrative at the top of this page talks about what is a tax agreement. Do you see that?
Yes.
Okay, it says the company is party to the tax agreement with QVC Group, right?
Yes.
And isn't that the case that is a reference to the tax sharing agreement that you identified earlier in your testimony?
Yes.
Okay, and you reviewed statements like this in these SEC reports before they're filed, right?
Yes.
Okay. Now, there is a reference about Okay, so at the bottom of this paragraph, the sentence reads, the amounts of the tax-related payable balance due to QVC Group as of December 31st, 2024 was $32 million. Do you see that?
Yes.
And is included in accrued liabilities in the consolidated balance sheet. Did I do that correctly?
Yes, sir.
Okay. Now, to be fair, because I want to be fair in this case, because I'm showing when QVC Inc. owes us money, at the end of 2025, isn't it the case that QVC Group owed net $10 million to QVC Inc.?
That's what
reported here.
That's what it says, yeah.
Okay. And these numbers are accurate to the best of your
Right.
knowledge. Okay. There's no disclosure in any of these 10K filings of any multi-billion-dollar tax owed by QVCG to QVC Inc., right?
That's correct.
Okay?
That's the deferred tax liability?
No, I'm talking about payments owed under the tax sharing agreement.
Okay. No, there's not.
With that clarification,
Yes,
correct?
okay. Thank you.
Thank you. You can put that down.
Okay.
Okay, now we're going to go next to tab 3, which is JX11.
Okay.
This, for the record, is the QVC Group, Inc., 10K for year-end 2025, correct?
Yes, sir.
Okay. And you've reviewed this document before it was filed with the Securities Exchange Commission, at least for the tax matters?
Yes, I have.
And without flipping through any of the pages, is your answer the same? There's no disclosure of any $100 million, billion-dollar intercompany liability from QVC Group to QVC Inc. under the tax sharing agreement, correct?
That's correct.
Okay. So were you here when Mr. Sussberg, debtor's counsel, gave his opening statement?
I was.
Okay. And did you hear him make statements to the effect that QVC Inc. has overpaid its taxes to the tune of $500 million to QVC Group?
I did.
That statement is not correct, is it?
It-
Under the tax sharing agreement?
Well, it depends upon the context, I guess, right? I mean,
I'm asking you first, under the tax sharing agreement.
under the tax sharing agreement, I would say no.
Thank you. Okay, so let's now talk about the deferred tax liability. You were asked questions by Mr. Esser about this, and I don't want to repeat myself, but I may have to.
That's perfectly fine.
The deferred tax liability relates to the LINTA exchangeable notes, correct?
That's correct.
Okay. And the company's position is that this deferred tax will never become payable, correct?
That's our position, correct.
And that's what you've told the investing public, correct?
That's correct.
And that's what the company has told creditors in restructuring negotiations, correct?
I don't know. I
Oh,
haven't.
you didn't participate in those?
I did not
Fair
participate in
enough.
this.
I shouldn't ask
Yeah.
that question. Okay. Now, you testified earlier that you have been involved with the process to procure tax insurance for this deferred tax liability, correct?
I was involved in part of the process. I wouldn't. It depends upon. We'd have to get specific, but I was involved in part of the process.
But this is very important to you, right? Because you're an actual insured under that policy, right?
I am.
Okay. And who else is insured under that policy, as you understand it?
Bill Walsh. Well, I don't know if I'm the only. Bill is Bill. I don't know.
Let me withdraw that question. I wasn't talking about any other individual.
Okay.
What companies?
Oh,
are-
QVC Inc. is.
Okay.
Yeah.
Is QVC Group an additional insured as well?
That I don't think so. I don't know the answer to that.
Fair enough. So When did the company get the tax insurance policies, approximately?
I know they were effective March 31st, 2026.
Okay. And did you have a commitment from the insurance companies before then?
There may have been a commitment before that. There more likely was, because everything's signed and dated March 31st. What exactly got executed before that, I'm not sure, but normally there would be a commitment, I would think, if you're executing documents on the 31st.
Right. Okay. So, and the company has used outside advisors on this deferred tax liability issue, including, again, PwC, right?
That's correct.
Okay. And Kirkland Ellis has also been involved in that process, right?
That's correct.
Okay. Now, the company came to the conclusion sometime in the late 2025 timeframe, early 2026 timeframe, that this deferred tax liability would, in its position, would not come to fruition, right?
That's correct.
Okay.
Well, I don't know about the word won't come to tuition. Our position is that it's not taxable, but not without an element of risk.
Fair enough. Okay, so now I'm going to tread very lightly.
Okay.
Because Mr. Esser has told me what I can and can't say. I'm going to do my absolute best, and I think you need to do the same.
I'll try. I'll go slow.
All right. So now, as part of the process to get the tax insurance, you had to get an opinion from PwC, correct?
Yes. Well, I had to get a tax opinion, yes.
Thank you. And that was actually a requirement for the insurance companies that gave you the taxes, correct?
That gave us the insurance.
I'm sorry.
Yeah.
That was the requirement of the insurance companies who are insuring against these taxes.
Yes.
Okay, thank you. So when did PwC finish its work for that opinion?
Oh, I want to say it was in February of 26.
Okay. And at that time, you were informed, were you not, that they were going to give you what is known as a should tax opinion, right?
Yes.
Okay. And the sum and substance of that opinion is that the company should not ultimately be liable for that deferred tax liability, correct?
That's correct.
And that's consistent with the company's position, right?
That's correct.
Mr. Esser asked you about this, and I think there was a little lack of clarity in some of your answers on what this should opinion means. I don't blame anybody. I just want to make sure it is clear and I understand it. So what is the lowest level opinion? Isn't that a reasonable basis opinion? It
is.
Okay. And that's when a tax professional like PwC indicates there's approximately a 33.33% chance of the tax opinion being correct.
I would agree with that in general.
Okay. And then the next level opinion is a substantial authority opinion, correct?
Yes, sir.
And that's something between 33% and 50%, right?
I would agree with that.
And then and then the next level of opinion is a more likely than not opinion, correct?
That's correct.
And what that signifies to you as a tax professional is that their confidence amounts to something at least 50.1% of confidence that their opinion is correct, right?
I would agree with that.
And then the next level of opinion is a should opinion, and that's what PwC has delivered here, right?
That's correct.
And that signifies to you as a tax professional that their confidence is somewhere between 70 and 80% that their opinion is correct, right?
I mean, look, some professionals may say it's a little bit lower than that. We're talking ranges here. You know, it's above more likely than not, and it's certainly not above 80% in anyone's world, I don't think. So some professionals may say it's 65. We're talking ranges here, but it's certainly not above 80.
Okay, and then a will opinion is the highest level opinion, and that's where the tax professional is telling you there's at least 80% certainty that their tax position, their tax opinion is in fact correct.
Well, different companies have different service providers have different levels on that, but it's the highest level opinion you can get.
Okay. And in this case, the insurers accepted the PwC should opinion and provided the company with the tax insurance of $925 million as a result, right?
That's correct.
Now, you have not personally quantified the risk of the company's tax position like PwC has, right?
I mean, I'm a tax professional and I know what the issues are, so I have a view that there's risk in the treatment.
Well, there's risk in even a will opinion, right? A will opinion is...
Yes, thank you. Yeah.
Okay. Now, you testified earlier that the premium for the $925 million of insurance is approximately, I think you said, $35 million.
I did. That's correct.
So the company paid $35 million to insure a $925 million risk, correct?
That's correct.
Now, I want to go to your demonstrative that you talked about with Mr. Esser.
Can you re-ask that last question? I want. Can you make sure I understand? Make sure I answered that right. Could you ask that last question one more time?
The company paid $36 million for $925 million of insurance.
Yeah. Okay.
For the deferred tax liability.
That's correct.
Thank you.
Sorry.
No problem. All right. So I want you to go to your demonstrative exhibit. Well, actually, let me ask you a question. Yeah, get the white binder out, if you will.
Okay. What page? What section?
Before we get to that, I have a question I haven't asked you, and I didn't ask you your deposition. So, as a result of this plan that the company has, if the plan actually is approved and goes effective, will the company have a worthless stock deduction, QVC Group, when it liquidates and it loses its equity interest in QVC Inc.?
What company are you talking about now?
QVC Group.
I don't believe so. These calculations are immensely complicated, but I don't believe so.
Okay. Thank you. So let's go to your demonstrative again.
Okay. What tab? What tab is that? Does anyone know?
Just bear with me. Okay, so we're in the first tab,
Oh.
and at the paragraph right right above source DX 435. You have a statement there. This number also varies based on the number of interest deduction carry forwards available.
Right.
These may be at risk due to trading of preferred, triggering a potential ownership change under Section 382 of the code. Do you see that?
Yes, sir.
Okay. And then in your second demonstrative, at the bottom, you say, these numbers assume, carry forward impact. These numbers assume that there has not been an ownership change under Section 382 of the code. Do you see that?
Yes, sir.
You don't know whether there's been an actual ownership change under these provisions, do you?
Not currently, no.
Okay. And so going next to the So are you aware that the company filed a motion to stop trading in its publicly traded securities or to limit the trading to preserve the company's NOLs?
I am.
Okay. But your testimony today is that the company doesn't really have any NOLs to speak of, right?
That would be correct. We got tax attributes.
Okay. And would the trading affect those tax
Well,
attributes?
this is what we were talking about before. It would affect the 163J carry forward, the big interest carry forward.
Okay. So on the NOLs themselves, if the NOLs are eliminated based on trading activity, who is the party that would lose out on using those NOLs?
You're talking about interest expense?
Well,
or?
if the ever,
It depends upon we'd have to go back to the tax sharing agreement, right?
okay, let's focus on state tax NOLs.
Okay.
Isn't it the case that if the NOLs are ever monetized and used for tax purposes, the parties that would benefit from that are Liberty Broadband and Liberty Media?
On a large portion of them, yes.
Not the Chapter 11 debtors in this case.
There's a piece that is Topco's as well, but a piece would go to Broadband and to Liberty Media.
So I have one last question for you, sir. Now, we've gone through the spectrum of percentages of risk that the company's tax position will be proven correct. So the question I have for you is, we calculate the percentage of the premium that's going to be paid to these insurers versus what they're covering at around 3.8%. Is that math correct?
I assume if you've calculated, I'll assume that you're right on that.
I'm a lawyer. I'm probably off a little bit.
Okay. I'll take that as an assumption.
And that's what the insurers have accepted to insure this risk, right?
Okay.
So if we translated that 3.8 plus or minus risk, what spectrum of these tax opinions, what level of confidence would that translate to? Isn't that basically the same as a will opinion?
I don't think that's how, I'm not an insurance expert, but I don't think that's how insurance works.
But if it is 3.8%.
I mean, I've never had a fire at my house and I got to pay, right, a certain, the insurance market, it does not work like that to my knowledge.
Okay, but 3.8%, if the tax professional said the risk is 3.8%, that would be a will opinion, right?
It probably depends upon the issuing accounting firm, but I don't think you can equate a dollar amount you pay for insurance coverage to what a tax professional opines on in a level of opinion. It's just, it's apples to oranges. You're going to the insurance market to insure something, and you may have a opinion, but it's based upon all sorts of facts and code sections and interaction of the two. And I just don't think you can take a premium and divide it by the insurance coverage and try to equate that with a level of confidence on a tax opinion. I just don't think you can.
I think you can, but I will end my testimony there. Thank you.
Okay, thanks.
All right, anyone else wish to cross-examine Mr. Dresser?
Your Honor, if I may just have 1 minute to confer.
Sure.
Mr. Kearns, I'll try to be brief. Sir, you were asked about TSA Section 2. Can we just turn to DX002 in your binder? Your white binder.
Yes, sir.
And on page 4, which is QVC_0019039, we see Section 2 here. And this section pertains to the payment of separate return tax liability by QVC to Liberty. Did I get that right?
Yeah, well, yeah, yes.
Okay, and the first sentence says, with respect to each taxable period for which a joint return is filed in any tax jurisdiction, QVC shall pay to Liberty an amount equal to the separate return tax liability. Is that right?
That's correct.
Okay, and we talked about the name change there. What did Liberty end up becoming?
Liberty ended up, in this context, Liberty ended up being QVC Group, Inc., Topco.
Okay, and before this agreement was assigned formally to, sorry, that's right, okay, thank you, sir. Now, you were asked one question about the continuous audit program.
Yes.
Sir, the company will not be in the continuous audit program for the 2026 tax year, correct?
That's correct.
Okay. So the IRS won't be asking you right away about the deferred tax liability. Is that correct?
That's correct.
Okay. Sir, you were also asked about overpayments on the TSA being recorded as a payable or a receivable. Do you recall that?
Yes.
When you understood the term overpayments, did you understand that to be a literal overpayment on the amount that was owed under the TSA?
I understood it to be if we made estimated tax payments and the tax liability at the end of the year was less than the estimated tax payments. That's the context in which I understood the question or my related answer.
Right, and not to be the surplus amount that was left over after QVCG ended up paying out what it owed on the tax.
Right, I mean, there's just, no.
Okay. Now, sir, QVC Inc. paid what was due under the contract, correct?
That's correct.
That was more than QVCG owed to tax authorities.
Absolutely.
And then, sir, just talking about the risk aspects and the percentages, I want to confirm one thing. You know there is risk the debtors have, correct?
Absolutely.
And finally, just on the state NOLs point, wanted to give you a chance to explain, will Cody eliminate state NOLs?
Well, yeah, I mean, it's either going to be, yes, they're going to be gone.
Thank you.
Anything further?
No, Your Honor, thank you.
All right. Thank you, sir. You may step down. One more?
Your Honor, if you're willing to go, we are too.
I am.
Fantastic. Thank you, Your Honor. By the way, this is Mr. Esser's day. We call it Esserfest. So he is the third witness as well.
I'm stepping aside, thank you.
I just want, if I may confirm one thing, I just want to make sure we have Mr. Kai's binders in the courtroom.
Okay.
And Your Honor, can we just confirm Mr. Kearns is released?
Yes, he's released.
Thank you, Your Honor. Here's all this shit. Just leave it all.
Okay, Your Honor, at this time we'll call Mr. Jason Kais to the witness stand. And once again, Your Honor, we have witness binders, if I may approach.
Raise your right hand, sir. Do you solemnly swear or affirm to tell the truth, the whole truth, and nothing but the truth?
I did.
All right. Please be seated.
Thank you.
Sir, could you please state your name for the record?
My name is Jason Kais.
Sir, where do you work?
I work at Alex Partners.
What is Alex Partners?
Alex Partners is a global consulting firm with 3,000 professionals in offices across 25 offices across multiple countries.
What position do you hold at Alex Partners?
I am a partner and managing director at Alex Partners.
In what group?
I am in our turnaround and restructuring group.
And how long have you worked in the restructuring space generally?
Over 15 years.
What is Alex Partners' role in this case?
Alex Partners is the proposed financial advisor to the debtors.
Sir, when did QVC Group engage Alex Partners?
We were first engaged by QVC in May of 2025.
At a high level, what was Alex Partners retained to do?
At a high level, we were retained to provide advice with respect to strategic alternatives, help the company put together a business plan, help them with liquidity forecasting, and if we needed to help the company prepare to file Chapter 11, which we did, and related services to those core things.
Now, sir, over the course of your engagement, have you become generally familiar with the debtor's day-to-day operations?
Yes.
How so?
Well, the general things we were hired to do covered a lot of areas. So we got to work very closely with the finance team. We got to work closely with the HR department in prepping to file Chapter 11. We worked very closely with some of the merchandise planning teams to help the product continue to flow across the world. Various departments we interacted with the company.
Sir, I'd like to talk to you about the Cornerstone Brands, Inc. entity. Are you familiar with that entity?
Yes.
What is that entity?
Cornerstone Brands, Inc. is a legal entity, and it holds some other entities below it. But the main business for Cornerstone Brands, Inc. is it holds 4 brands. They're called Ballard Designs, Frontgate, Grandin Road, and Garnet Hill. Those are all of our operations of those 4 brands take place underneath Cornerstone Brands, Inc. And above Cornerstone Brands, Inc. is an entity called QRI, Cornerstone, Inc. That is the entity that we've been talking about that is owned 62% by QVCG and 38% by Linto.
Your Honor, I'm just passing a note that we once again need to enable Mr. Perez's, for screen for Jose. Thank you. It's Jose Lopez. Thank you.
I got it. You have it now? Okay.
Thank you. Sir, you've already generally described the CBI business for the court, but how does CBI generally reach their customers?
Sure. CBI historically is a catalog business, so you would send they would send the catalog out to consumers' homes, and they would order that way. CBI also has 34 stores, and everyone now today is on the internet, so obviously CBI now does a lot of marketing, digital marketing, social media marketing, things like that to get customers.
All right. When did your work with CBI begin?
So we started working with QVC back in May of 2025. The initial steps were to gather a bunch of information about QVC, QVCG and all of its subsidiaries, various countries, on the various subs, and we gathered a lot of information on CBI as well, and looked at the trends of the business, the KPIs, and then around in July, we sat down and started meeting with the CBI team specifically to talk about the business plan.
And who specifically at CBI did you start working with?
Sure. So at CBI, we met with Kenneth Walker, that's the divisional CFO, Andrew Burke, he's the controller of CBI. There's also Jessica Donati, she is the head of it, well, she's an FP&A at QVC, along with Chad Ramsey. They help out FP&A at CBI. We also met with Bill Wofford, who is the CFO of QVC, but also the treasurer and executive vice president of QRI Cornerstone, the entity I talked about earlier. And then, we also met with David Rollinson, the CEO of QVC, on the plan.
Now, when you first started working with the business, did you observe anything about the business trajectory for the business for the few years before you got involved?
Yes, yes.
Now-
Yes.
Please,
please.
did you prepare a demonstrative to help with your testimony on this subject?
Yes.
Can you please turn to Kai's DEM-1 in your binder? It should be the first tab there. Sir, what is this graph showing us?
So this chart shows 3 data series. I think this is black or dark blue. The dark blue line is the number of homes sold in the United States for that period of time for that year. The light blue line is the revenue for CBI over that same period of time. And then below you can see OIBDA margin. Those are some numbers with some percentages. So 4% OIBDA margin 2017, 2% OIBDA margin 2018.
Now, what trend did you notice in this data?
The trend that noticed is the homes sold in the United States trended up from 2017 into 2021, and then the CBI revenue really followed that trend.
Okay. Now, I see a reference to OIBDA margin here. What is that?
So, in the case of QVC, we call the core measure of profitability is called OIBDA. Most businesses would call something EBITDA. In our circumstance for CBI, it's basically the same. So we refer to OIBDA. You should think about it as similar to EBITDA.
So it's operating income before depreciation and amortization?
Yes. Yes.
Okay, so what's the difference between operating income and earnings? Is there an adjustment there?
It's really the difference between going up from the bottom of the P&L versus the top, from operating income down to OIBDA for EBITDA up. So it ends at the same place. I think there's some history behind
So do
why.
you take out non-cash items there or not?
This is a GAAP accrual basis. So you have to get the free cash flow, and I think we'll get to it in a bit. You have to take additional things below that. It's like CapEx, working capital. Interest, of course, would be on there. So,
Right.
Let's talk a little bit more about that metric. Can you turn to the next demonstrative, Kai's DEM-2? Sir, can you walk me through how the OIBDA margin number changed from 2018 to present in your chart here?
sure. And this chart it has some of the same data from the previous one. So you can see that the light blue is the revenue from 2018 to 2025. We have the actual revenue. And then the orange chart, that is the OIBDA margin. And you can see that the OIBDA margin went up from 2 to 4% in 2018. The home sales spiked. Everyone was at home during COVID. People weren't spending on travel and entertainment. They were sprucing up their homes. Company experienced a tremendous tailwind behind that, and then that period came over, and the performance of the business has declined on a revenue and OIBDA margin basis.
And does this assume that the restructuring has taken place in the projected years 26 through 29?
There's no revenue. This is just CBI only. Okay. So this is sort of standalone, ignoring potential impacts of a Chapter 11. But this is saying here's the revenue of CBI on its own.
Okay.
I want to clarify one point there. Do the revenue projections here for the go-forward years assume that CBI remains part of the QVC mothership?
The work we identified, there's no impact to revenue when it stays on par from the revenue basis, but there are differences when it's on a standalone basis versus part of the QVC mothership from a cost perspective.
Okay. So let's look, that's fair. Let's look at the revenue numbers you're projecting for 26, 27, 28, and 29. So what are you projecting in 2026?
Sorry, and let me go back to that first one to clarification. We do have some OIBDA margins under here, so the OIBDA margin does assume it's part of the QVC mothership. But the revenue, it should not be any different. Sorry, what was the last question?
Yep. What are you projecting for revenue in 2026 in this chart here?
The 2026 chart, $940 million for revenue.
And how about in 27?
$950 million.
And 28?
978,
and 29.
just over $1 billion.
Okay. And then your OIBDA trend line is going up as well. Is that fair?
Yes.
Okay. So we've been talking about the performance to date and a little bit of the projections. I want to talk about the business plan itself. Does the company currently have a business plan?
Yes.
Okay. Can you turn to Kai's down 3? What is the name of the business plan?
There is referred to a business plan, but some of the core initiatives underlying the business plan is referred to a series of initiatives called CBI 3.0.
Okay. And you said a series of initiatives. Are there 4 of them?
There are many initiatives, but there are 4 focus areas of the initiatives as part of CBI 3.0.
Thank you. Let's talk about the first one I see on the screen here. What is product margin improvement?
Product margin improvement, this is, what it says, we're trying to improve the margins of our products, but primarily by lowering our landed costs, cost engineering something, if something's more expensive to make it less expensive by just changing the composition. It also involves, having more optimal pricing with respect to what we're selling, things like that.
Number 2 is cost to serve. What is that?
So cost to serve is, when, other than the products, like how we get products to our customers. So one example is becoming more efficient in our warehouse, where we go from storing a good, picking it from the racks, placing the order so we can get them out. So that's one of the areas that we're trying to lower cost to serve.
Third is marketing efficiency. What is that?
So we spend a lot of money to get to customers because we don't have a lot of stores. So becoming more efficient with our marketing dollars per dollar profitability is just an important activity for us.
Finally, store operating leverage. What's that 4th focus area?
That just means getting more profitability or revenue from our stores. So one example is training our employees to be more sales oriented in their selling and more design oriented in the store.
I want to clarify one thing. Were these performance improvement focus areas already in progress when Alex Partners was retained last year?
The initiatives themselves, when we sat down with the management team in July of 2025, they had already largely identified the initiatives. So there was various stages of the initiatives as far as their execution, other things that have to be done along the way, but they had largely been identified already when we started.
And what have you done to aid the business in implementing these initiatives?
Well, part of when we started sitting down with them in July, we helped them put together the business plan. We spent a lot of time looking at the brand by brand performance, how that was trending, what KPIs the management team thought they could hit with respect to the CBI 3.0, and then using those inputs, develop the business plan projections.
All right. So you may have just answered my next question, which is, are these initiatives already reflected in the company's go-forward financial projections for the CBI business?
Yes.
Okay. I want to talk briefly about catalog circulation. You mentioned the company has historically been a catalog business, but I want to quantify that. Let's look at Kai's down 4 in your binder. And sir, could you walk us through how the catalog circulation has trended for the CBI business from 2022 through 2025?
Sure. So in 2022, CBI distributed 155 million catalogs, so quite a lot. And as consumer behavior has been changing, and actually it's become more expensive to print and mail the catalogs, and they've become, more and more consumers are digitally oriented. So the company has been reducing its catalog circulation. I think the total from 2022 to 2025 is down around 52%. And the company plans to further reduce the catalog circulation next year to 67, or I should say this year, 2026, to 67 million catalogs.
Let's switch gears a little bit. I want to talk about the financial projections you just referenced assisting the company put together. Can you turn to DX13 in your binder?
Yes.
And sir, this is a document titled Cornerstone Brands, Inc. Discussion Materials 5-Year Financial Projections, and it's dated December 2025, correct?
Yes.
Do you recognize this document?
Yes.
Did you help prepare it?
Yes.
Okay. If you could turn to page 3 of 22 at the top, bearing Bates number QVC underscore 0063295. Sir, who presented this presentation?
So this was, these materials itself, this is, if you just look at the bottom of the page, this is what was cleansed and produced through the SEC websites. And this was a version of the business plan that was presented externally to stakeholders. And looking on page 3, this was presented by David Rawlinson, the CEO of QVC, Bill Wofford, the CFO of QVC, and Tom Bazzone, who is the president of Cornerstone Brands, CBI.
Okay, and why were these projections put together, and who were they presenting to?
The projections themselves were distributed to, again, this was a version of the presentation that was that had been shown a couple times. This specific presentation were to the bondholders and the bondholder advisors of Linta.
Thank you. Let's talk about one clarification. Were you at the meeting itself?
Yes.
Thank you. Let's talk about the financial projections in this document. Let's go to page 20 of 22 at the top. Let me know when you're there.
All right, what was the number? What's the page number?
Page 20 of 22 at the top, which is QVC underscore 0063312.
Yes, okay, I'm there.
Okay. Sir, are these the financial projections you helped put together with the company around this time?
Yes, page 20 is the summarized P&L from revenue to EBITDA for 2025 through 2029.
And what is CBI's projected OIBDA for the years 26 through 29 here?
$30 million in 2026, 33 in 2027, 35 in 2028, and 42 in 2029.
Okay. Now, I'd like to also focus just briefly on the net revenue line and have you confirm that those numbers for 26 through 29 are the same numbers we previously saw.
They look the same to me.
And in 2026, what are you projecting in net revenue here?
$940 million in 2026, $950 million in 2027, $978 in 2028, and just over $1 billion in 2029.
Okay. I want to switch gears. Let's talk about the financial projections that were in the disclosure statements. Are you aware that the debtors have filed a disclosure statement? There are certain financial statements in there. Sir, are you aware of whether Evercore prepared a valuation of the CBI entity?
Yes.
And were the same projections that underlied the projections in the disclosure statement used in the Evercore valuation to the best of your knowledge?
Yes.
Okay, I want to talk about those. Can you turn to Kai's Dam 5 in your binder? Now, sir, let's talk about the net revenue line for 2027, 28, and 29. What are those?
It is $950 million in revenue in 2027, $978 in 2028, and just over $1 billion. $1 billion, I think that's $8 million in 2029.
And how about the OIBDA numbers here for 2027, 2028, and 2029?
That is $33 million in 2027, $35 in 2028, and $42 in 2029.
Now, sir, taking a step back, what does the unlevered free cash flow line item reflect?
So I think to the question earlier, this reflects getting from OIBDA to how much cash is projected to be generated by the enterprise for the period of time. So if you can see just in 2027, that's $33 million of OIBDA. There's $23 million in CapEx projected, some cash taxes of $6 million, and then some changes to working capital, $1 million, to result in $3 million of unlevered free cash flow for 2027.
Okay. Now, I want to also talk about how that ultimate conclusion, the unlevered free cash flow number, may have changed between the December cleanse projections and the financial projections that underscore the disclosure statement. Did you prepare, actually, did you make a presentation on that?
Yes.
Okay. Let's turn to that. That's at DX268 in your binder. And if we could turn to the second page of that document with a Bates stamp, QVC underscore 0084195. So, sir, what are we seeing here on this table?
Sure. So there are a couple of boxes on this table. The middle box, the turquoise box, those are the numbers that were cleansed in the document that we just walked through from December 2025 in that presentation. The orange piece, that orange box, that is what rolls up into the disclosure statement. The disclosure statement was presented on a consolidated basis with CBI as part of QVC Inc. And the international subsidiaries. And then the pink box, this is just the delta between those 2 points in time, between December 2025 and April 2026.
And so, sir, walk us through this, but from my reading of this, there are no variances in the OIBDA line and above on this sheet. Is that correct?
That's correct.
And then why don't you walk us through what the variances are below the OIBDA line leading up to free cash flow for the years full year 2026 that you're showing here in the, I think, fourth column from the right.
Sure. So just sticking in the variance section for the moment, there were some changes with the line items below OIBDA. So there were some updates to the cash tax projection at that point in time. So the cash tax projection went up. There was also some adjustments to CapEx as far as in the plan. And then there were some larger changes in working capital as part of the plan.
Thank you. Now, I want to be clear. The Evercore team is using the projections on the left, the cash flow from April 2026, correct?
Yes.
Okay. Now, in the working capital line item, what makes up for that variance?
Sure. So working capital traditionally is inventory, accounts receivable, accounts payable, other accrued or other liabilities. In this instance, between December and April, there was a couple of changes. Firstly, with respect to the ruling from the Supreme Court with respect to IEPA. So there was the change in by April that the company would potentially get a refund. So the orange box assumes that there is a refund with respect to the IEPA tariff, and it also assumes that there's additional new tariffs put in place by the administration that offsets that, during this year.
Okay, sir. Have there been any new tariffs announced recently?
Yes.
Okay. Now, sir, I'll ask this question now that we have the free cash flow line item here. Do all of these projections assume CBI is part of the mothership?
Yes.
All right. And by mothership, I mean the QVC mothership, to be clear.
I understand.
All right.
I understood the mothership.
Okay, let's talk about the current performance of the business to plan so far this year. Has the company put together any analysis of CBI's current performance versus plan?
Yes.
What have they done?
So the company has prepared what's called a 4+8. So that is what the first 4 months of the year look like, and then there's 8 months tacked on at what the current outlook is based on what you know from the beginning of the year. So the company has prepared that, and we examined that.
And have you looked at how that compares, how that 4+8 compares to forecast?
Yes.
Did you prepare a demonstrative for that?
Yes.
Let's turn to Kai's Dem 6, please. All right, sir, why don't you walk us through the left chart here?
So the slide, Kai's Dem 6, on the left-hand side, this is a chart showing the blue box is the revenue that was projected for 2026 with respect to CBI. And the pink, this is the current 4+8 forecast. So as you can see, the current reforecast has the company missing revenue by $33 million. The box on the right, this shows OIBDA, similar color scheme. $30 million of OIBDA was projected for 2026. The company's current 4+8 has it missing that projection.
Okay. Now I want to talk about if the business were not part of the QVC mothership. Have you done any analysis quantifying the impact to CBI were to leave the QVC mothership?
Yes.
Let's turn to Kai's demonstrative 7 in your binder. Now, sir, without going into each line item yet, what work did you do to put this together?
Sure. So my team and I, we met with the CBI management team. We had several discussions about where we thought in a scenario where CBI would be separated, where there could be some additional costs in that separation. We also had, during that time, had developed a lot of knowledge about how QVC was working and how it was performing services for CBI. So that was the work that we did in the process we went through to perform this analysis.
Now, sir, why did you put together this separation analysis?
At that time, we thought there would be a significant chance, or a chance that CBI would separate from QVC.
Okay. Sir, I see a row for UPS agreements. What costs would CBI incur if it's separated from QVC?
Sure. So as we sit here today, CBI and QVC are in the same agreement with UPS. And what is kind of remarkable that I learned is that QVC spends around 12 times as much money with UPS as CBI. So they've been able to negotiate a very favorable agreement with them. Just to order of magnitude, they spend $800 million with UPS in a year, so it's a large amount of money.
And so what are you showing in terms of dyssynergies were the company no longer to take advantage of that UPS agreement?
The analysis shows that the contract ends in the middle of 2027. So the estimates are around $8 million a year of benefit would go away from CBI if that separation were to occur.
Now I see a row for new employees. What new employees would CBI need if it were to depart QVC?
There are a number of services that QVC performs for CBI, things like insurance or helping with FP&A, things of that nature. So this is reflecting the hiring of those new employees to help out CBI.
And then the next line item is outside services. What new outside services would CBI need?
So there are currently outside tax services provided to QVC that are passed along to CBI. There's also some legal outside services. Things like that would also need to be taken on by CBI.
And what did you quantify that dyssynergy to be?
$700,000 a year.
All right. Now, how about the IT services and audit line item? What's that?
So in this line item, because QVC is so much bigger, they have 10,000 plus employees. QVC is able to negotiate agreements, with a scale of that number of employees. So we have an estimate of what the additional costs they would have to incur because they don't have that scale anymore in those negotiations.
Now, the final line item before the total is management fee, and that's a positive number. What does that reflect?
Currently, there is an intercompany charge from QVC to CBI with respect to some of these services. So the plus 2.2 and the 2.3 is just the assumption that management fee goes away.
And so, sir, in total, what would you project the incremental cost to the business plan to be in the next 3 years if CBI were to leave the QVC mothership?
$25 million.
Okay. Want to switch gears, and we can take that down. Sir, are you aware that the debtors filed a disclosure statement in this case?
Yes.
And did that disclosure statement include a liquidation analysis?
Yes.
Could you please turn to DX 179 in your binder? And let's turn to page 395 of 407 at the top. Sir, can you please walk us through what we're looking at here?
Sure. The liquidation analysis was prepared based on 4 different boxes. the liquidation, so it was prepared for QXH/QVC Inc., CBI, Linta, and QVCG, based on where the main debt holders and stakeholders are. And this page we're looking at is for the liquidation analysis of QVCG, QVC Group Inc.
Okay, great. I want to focus on the line item here for potential intercompany claim. Can you please explain that for us?
Yes, the potential intercompany claim here is the $400 million claim is in the low and the high case is assumed in the liquidation analysis.
Okay, and now what is the assumption you are making with respect to this proposed intercompany claim?
The assumption in the liquidation analysis is that the intercompany settlement claim of $400 million, that the settlement, everything around that, holds in a Chapter 7 liquidation.
Okay, and now, sir, if you remove the $400 million line item for potential intercompany claim recovered, could you just automatically assume there would be a recovery to equity in this liquidation analysis?
No.
Why not?
The scenario you're describing, this hypothetical where the settlement goes away, that would be a world where there would be additional litigation to resolve the issues at hand. So there would be additional costs in place. That also would be potentially a terminable event under the RSA. So that could, have other implications just related to that. And then, of course, there is the outcome of the litigation itself on how it's actually resolved. So to work through that, I think you'd have to know what those variables were.
Thank you. We can take that down. I want to go back to the pre-petition engagement with the debtor stakeholders. Sir, were you involved in that process?
Yes.
And did you participate in any diligence efforts with creditors?
Yes.
And specifically, what stakeholders were involved in diligencing the company?
There was a tremendous amount of diligence during this process. There were stakeholders and advisors at the Revolver Group. QVC Inc. had a law firm and investment bank. The note holders of QVC Inc., they had a law firm and investment bank. The same with Linta. There was also disinterested directors at the 4 boxes, and they had lawyers, so they were all doing diligence, and it was a lot.
Let's turn to DX 265 in your binder. And sir, this is a document entitled Restructuring Funding Analysis, CBI, March 20, 2026. Do you recognize it?
Yes.
Sir, why was this put together?
At various points in time leading up to the Chapter 11, we were monitoring the liquidity situation of the various boxes. And this analysis was one of the several versions we prepared for CBI in evaluating the funding need, if there was, and the funding situation of CBI at that time.
Let's turn to slide 8, which is Bates number QVC G underscore SC underscore 0000705. And let me know when you're there. And sir, I see in the bottom left-hand corner a reference to 3 scenarios, scenario 1, scenario 2, scenario 3. What were those scenarios you were modeling?
There were a few different things going on at the time. There was a higher case, a mid case, lower case. We had also, at the time, I think this was back in March, one of our credit card processors was sitting on our cash. Our customers would pay them, and they just sat on it. So there were some different assumptions about the timing when we got that back. So there were some different assumptions underlying these scenarios, but in essence, there was a better case, a lower case, and a case in between.
Okay, now I'd like to look at the chart at the top. And can you walk us through the potential forecasted liquidity based on those scenarios?
Sure. So the blue line, that is just the scenario 1, this better case. The pink, this middle case, and the orange was the lower case. And importantly, if you see there's this red dashed line, that's 40 million of cash, and this was the critical point we were very focused on at this time.
And in all cases, did the company either go below or come near that critical line in your scenarios?
Yes, yes. It was in scenario 2, it was below the line. Scenario 3, it was below the line. Scenario 1, it was just barely above it. And the concern is, the company had never gotten during any of our time to liquidity that low. And the concern was that once you get to liquidity that low, that you're going to have to stop paying vendors, and it could lead to operational disruption, particularly in the context of, there's a lot of press about QVC imminently filing Chapter 11.
Okay. We can put this document away. I want to talk next about those pre-petition negotiations you referenced with lenders. Let's look at DX404 in your binder. And so this is a presentation bearing the name Centerview Partners and Aiken in the top right-hand corner, and it's entitled Project Courts LILLC Group Counterproposal dated January 15, 2026. Do you see that?
Yes.
Do you recall seeing this proposal in your negotiations pre-petition?
Yes.
All right. I'd like to go to the next page, which is QVC G_SC_00000049. And I want to focus on the row here that is focusing on Cornerstone restructuring. Sir, the first bullet in that middle row provides QRI Cornerstone Inc. CBI treatment to be determined, potentially sold, liquidated, or contributed to reorganize QVC. Do you recall receiving this proposal?
Yes.
And what was the debtor's reaction to this proposal?
So the debtor's reaction, particularly on the second bullet, right before this, we had also been requested by the Linta bondholder group to perform a liquidation analysis of CBI. The context here not being the Chapter 7 liquidation analysis of CBI, but what it would look like if we were to do a Chapter 11 plan of liquidation for CBI.
And did you, in fact, do that Chapter 11 liquidation analysis for CBI?
Yes.
And why did you do that?
The evaluation was to really figure out what Linta thought they could get or not get if they did not fund Cornerstone.
Thank you. If I may have a moment, Your Honor. Your Honor, I am ready to pass the witness. I want to just note one thing for the record. We have had a discovery schedule that has contemplated expert reports being exchanged all the way up until yesterday. And Mr. Kais was originally deposed in his capacity as a witness for the debtors. He has since submitted an expert rebuttal report in response to certain FTI expert reports. We've engaged with counsel to the preferred shareholders about that issue. We're going to reserve the right to call Mr. Kais in his capacity as a rebuttal witness next week, but subject to that caveat, I am ready to pass the witness. Okay.
We can take a 10-minute break.
Sure. Let's come back at 6:30.